Hello, welcome to week 12 in our course on basics of public finance administration. In the last couple of topics, we've been focused on the bond market, the market that is used for state, local, and even federal government entities to raise money and borrow that money to pay for projects and programs. In a couple of weeks ago, we looked at the concept of bonds as debt and how city governments, state governments, the federal government issues bonds, issues debt. We looked at the different kinds of bonds that there are in our topic a couple of weeks ago. And then last week, I introduced to you a method for how we actually calculate what the costs of those bonds should be. A city government needs to figure out how much money they're going to raise by selling these bonds, and it's that the money or amount that they raise is a factor of the interest rates that they are going to receive, and thereby the amount of money that they're going to get when they sell these bonds on the bond market. I've asked you in last week's topic to practice a little bit with making some calculations so that you understand how interest rates influence the cost and resale of bonds on the secondary bond market. And this week, I want to talk a little bit more about more strategic approach to looking at how city governments, local, state governments, and the federal government manages or looks at the cost of capital. What is it going to cost the organization to borrow money, and what are the optimum or the best ways to borrow money? The process for a local government or state government to make investments in buildings and repairs or improvements or any other capital investments like this requires us to estimate how much it will cost to finance the purchase. Uh, Issuing debt means that the city government is going to have to pay back that principal, but also pay interest on the debt that they have issued. And so we need to figure out how much it's going to cost to finance that purchase. Now, corporations in the marketplace today have more opportunities to get money than city or state governments and the federal government does. A corporation can sell bonds just like the city or state government can issue bonds and borrow money from the public and pay it back over a period of time. But corporations can also issue equity. They can sell stock. They can have a new issue of stock, or they can sell more shares of a current issue of stock on the market. And they can make a combination of stock and bond issues to get money so that they can invest and build in the company's future. Local and state governments don't have that same luxury. They only have the option of financing projects either through revenue generation, which comes from taxing citizens or charging more fees in certain areas, or borrowing money by issuing debt through the municipal bond market. What we're going to do today is just get an understanding of how a chief financial officer or a finance director in a city government looks at this issue called the cost of capital. How much is it going to cost the city, and what impact does it have on the big picture finances of the city? And we're going to look at that and I'll try to explain step by step some of these processes. Now, I don't want to worry you. You're not going to need to make lots of financial calculations. in this week's topic, but I do want you to understand these concepts that I'll be talking about. It's important that you understand the thought process behind making these kinds of public finance decisions. So let's start first by answering the question, what is the cost of capital? The best combination of an organization's sources of finance is called the optimal capital structure. Do we want to issue 30% bonds and 40% equity and get the rest 30% from our retained earnings, our company's retained earnings? What is that mix of debt and equity that allows us to get the lowest interest rate possible and to maximize our return on investment? That's called the optimal capital structure. And this combination allows us to leverage the organization's finances without putting increased financial risk on the organization. To say that another way, what we want to do is reduce the overall cost of financing. Now, corporate finance directors will look at stocks and bonds and their current retained earnings, the cash that they have in the bank, and they'll try to figure out that optimal capital structure. What percentage of each of those do they want to use in order to get money to invest in capital investments? Local governments, city governments, the federal government, basically they have just one choice, and that is to issue bonds. But we need to understand this idea called optimal capital structure so that we understand the thought process from a financial perspective that finance administrators go through in making these decisions. Now, how much a public organization, how much a local government will pay to borrow money is based on the market interest rate, right? If a city government needs to repair roads and they want to issue $5 million worth of bonds, the question is, what interest rate are they going to have to pay? And that interest rate is based on what the market interest rate is currently, but it's also influenced by a risk, a financial risk element that's associated with that particular local government. If the local government has a lot of debt, then the risk of buying additional debt is going to cause the interest rates to go up. If a city government has less debt, then the risk associated with getting paid back is going to go down, and the interest rate, therefore, will be lower. Now, corporations have to pay taxes on their profits. And so corporations go through a little bit different or an additional process, a thought process in figuring out the cost of debt. They want to look at what the current market interest rate is, but they also look at how much do they have to pay in taxes on their profits, because any interest that the corporation has to pay becomes an expense, and that expense reduces profits and therefore lowers taxes. So the interest expense becomes a tax deductible expense. Borrowing money, paying the interest back lowers their profits because interest is an expense. Local governments don't pay taxes, and so the issue of what the interest or income tax rate is doesn't apply to state and local governments. Nevertheless, we want to use essentially the same formula to calculate the cost of debt, to figure out what is selling a bond going to cost. Now, on the left-hand slide here, you will see the formula for figuring out the cost of debt. K subscript D means cost of debt equals the market interest rate times 1 minus the corporate tax rate. So let's say if the interest rate is 7.6% in the market to borrow money, and a corporation's effective tax rate on their profits is 35%. The cost of debt here would be the market interest rate times 1 minus 35% or 0.35, which is 0.65. Multiply 0.076 by 0.35, and you see that the cost of borrowing money to the corporation would be 4.94%, almost 5%. What that tells us is that if the corporation is going to borrow money, it's going to cost them 4.94%. They need to get a return on the investment greater than 4.94% in order to pay for that debt. So if they build a factory and the factory has a high profit potential, then it's a worthwhile investment if they can earn more than 5% on that investment. Now, that idea operates, for practical purposes, operates exactly the same way for local and state governments. A local or state government who wants to borrow money needs to ask the question, what is the cost of debt? And in this case, there is no interest rate, so really, there is no effective tax rate. And so the cost of debt is basically the market interest rate that's adjusted for the risk that's involved with the financial risk associated with investing in that particular local government. What factors influence the interest rate? Well, if we issue short-term bonds, the interest rates generally will be lower, right? As a long-term bond is issued, because the payback period is a longer period of time, and market interest rates will go up and down, they will fluctuate. Generally, investors receive a larger interest rate on long-term bonds. So that's a factor that influences interest rates. But then, as I've mentioned a couple of times already, how much debt the city government has currently is a financial risk. The nature of the economic environment is a financial risk. In good times, where the cost of borrowing is low, like right now in the marketplace, interest rates are at historic all-time lows and have been for a long time. Borrowing money costs less. In fact, that's a main argument that the federal government makes right now for spending more money on projects. You'll hear the current president talking about how his big infrastructure bill that he wants to borrow or spend $1.9 trillion. He says that this is at historic market lows right now. And if we have to borrow some money, we borrow money at very low interest rates, and we will get a much higher rate of return on investment, through the providing millions of jobs, through the infrastructure development, being able to generate more profitability and more productivity in the marketplace, and that will make the economy grow much more at a higher rate of return than the market interest rate that's currently charged for debt. Well, state and local governments look at those same things, but the economy could change, right? And as the marketplace changes, the economy changes. Financial managers need to look at and predict what might happen, and then factor that into the interest rate that they will offer on their municipal bonds. Figure 2.11 or 20, figure 21.1 in chapter 21 of the Mayo book, found in your book on page 334, shows this basic principle that the cost of debt for a period of time, short-term and medium-term debt, remains fairly stable. The interest rate that a city government would have to pay for 1 year or 5 years is essentially the same. But after a longer period of time, say 10 or 20, 30 years, the interest rate that will have to be paid on longer term debt will rise. As the use of debt increases as well as um, uh, cities' debt compared to their total assets uh, goes up, then the interest rates will rise as well. If the city has a low debt to assets ratio, then the interest rate will be lower. If their debt, the debt that they carry, is higher than in the average city in the marketplace, then the interest rate will go up. As interest rates increase to compensate investors, or interest rates will increase, I should say, in order to compensate investors for that financial risk. The risk of investing for a longer period of time, uncertain of market fluctuations, but also the risk associated with potential loss or default on that debt if a city's debt to asset ratio is too high. That's how we calculate the cost of debt. Now, a corporation will factor in other costs, the costs of issuing a preferred stock on issue, or the cost of selling more common stock, issuing more common stock on the marketplace. And corporations will consider what percentage of debt, what percentage of preferred stock, what percentage of equity, and even what percentage of retained earnings of the cash that they have in the bank will what percentage is the best percentage to be associated with, or that optimal cost of capital, the optimal capital structure. So corporations consider not only debt, but how much equity to sell to finance an investment. And this formula here looks a little bit complex. Again, I'm not going to ask you to make these calculations, but I really do want you to understand this, because this is a key financial principle that you would need to understand in any public administration position, whether you're working for a utility company, a state government, a local city government, if you're working for a public hospital. It doesn't matter what organization you work for, these principles operate the exact same way. So understanding this formula is pretty important. The formula that I've shown here on this PowerPoint is taken from an example in the text that begins on page 339. It's called the weighted cost of capital. The calculation tells us what the minimum return on investment needs to be in order to borrow money using this optimal cost of capital. So a chief financial officer will make this calculation to see what combination of stocks and bonds they should issue in the market. But the resulting figure that you see here is the minimum return on investment that would pay for the borrowing of the funds, or the acquisition of these funds. And basically we look at the weighted cost of borrowing money from debt, the weighted cost from issuing preferred stock, and the weighted cost of issuing common stock. And the cost of capital shows us this best combination of funds that we should use. Now, if you look at the example on the bottom of page 339, you'll see that we're assuming that a company will be able to sell debt at an interest rate of 5.2%, They would have to maybe pay a dividend of 8.9% on, or almost 9% on preferred stock, and the cost of common stock or retained earnings is 11%. So it's much more expensive, as you can see, to issue stock. The return on investment would need to be higher than the cost of borrowing money on the bond market. So uh, the question then for a financial officer is how much debt, or how many dollars in bonds should we sell, how many dollars in preferred stock, and how many dollars in common stock, and we can weigh that, and you'll see that kind of calculation on the top of page 340, assuming that the chief financial officer is going to sell 40% of the money needed in bonds, 10% of it in preferred stock, and 50% in capital stock. The weighted cost of capital here is that basic formula that you see right here on the slide. Cost of capital is the weighted average of uh, bond debt, preferred stock, and common equity. The example here, the numbers shown are taken from your book on the top of page 40, where you see 5.2% times 0.4 equals 2.08. 8.96% times 0.1 equals 0.896, and 11% times 0.05 equals 5.5. Add all of those together, and your cost of capital is 8.476. There's your cost of capital, and that's the minimum amount or return that a CFO would need to get by borrowing money using this optimal capital structure. um, the best combination, how do you figure out the 40%, 20%, the 10% formula? The cost of capital shows us actually this best combination of sources of funds, and it helps us to minimize or reduce that cost of capital by calculating optimal capital structure. It also, this calculation lets a CFO factor in and take advantage of cheaper debt. If interest rates are lower right now, then they could change that optimal capital structure. And of course, by lowering the cost of capital, there's going to be a benefit of minimizing financial risk involved. What's that optimal capital structure? What's that percentage? Well, you can see Exhibit 21.1 in your book on page 341 shows us that the more we borrow, the higher the cost of capital. But by weighing each of the debt and equity investments, we can see that there is an optimal combination at which we can have a lower cost of capital. This chart shows that if we're only borrowing the 10% of our, or the proportion of debt financing is only 10%, the cost of that debt is going to be low. It's going to be a lower interest rate because we haven't got a lot of debt. On the other hand, if our city has borrowed lots and lots of money, you can see that as the proportion of debt financing goes up, we will have to pay a higher interest rate. Why? Because there's a financial risk associated with investing in any organization that has too much debt. The cost of equity is a calculation made based on the market rates, but it's based on the balance sheet and the profit and loss statement of a corporation. And we can weigh those costs and see that there is an optimal cost. If we only borrow 20% of the funds as debt, and the cost of equity is 10%, we can see that the weighted cost is 8.8. But because for the interest rate is the same if we borrow more debt, we can effectively lower the weighted cost of capital. The interest rate for the cost of capital goes down. Then at the point where interest rates start rising, the weighted cost goes up. This lowest point here we call the optimal cost of capital. And it tells us that we should borrow about 40% of what we need by issuing debt. The rest should come from issuing stocks or using retained earnings. That's the optimal combination. And this chart shows that the more you borrow, the higher your cost of capital will be. But at a particular point, there is an optimal or a best rate that gives you or minimizes the cost of capital. Now, preserving this optimal structure. This is a formula that generally doesn't change too much over periods of time. It's an optimal formula that a corporation will use in order to look at financing investments, and that formula, the optimal structure, capital structure, doesn't really change, but the in fact, the actual cost of capital may change because interest rates change over time. Interest rates fluctuate. So even though a company's optimal capital structure may say we should borrow 40% in bonds, well, 3 years ago, maybe the company issued bonds and was only paying 3% interest, but today they have to pay 5% interest. The actual cost of capital may go up, but the optimal structure, how much we borrow by debt and how much we borrow by equity, will generally not change very much. So if this is an important idea to understand, because over time, if an organization wants to borrow additional funds, if they want to go out to the market and issue more debt, and or they want to get, say, $100 million for huge capital investments, they may use that same optimal capital structure: 40% debt, 10% preferred stock, and 50% common stock. But the actual cost of financing that additional debt may go up, and we call that the marginal cost of capital. The marginal cost of capital is the cost of adding borrowing to our financing. If we've borrowed before and then we add more borrowing to our corporation's balance sheet, or to our city's balance sheet, if you will, then that additional amount, called the marginal cost of capital, will change our finance or our return on investment. It will change the risk associated with borrowing. This marginal cost of capital can go up or it can go down depending on what's happening in the free market, what's happening with interest rates. Again, I'm not going to ask you to make any calculations here at all, but I want you to understand that the cost of capital is an important calculation. It's based on what's happening in the marketplace. What are the current market trends, as well as what are the risks associated with investing in that entity, whether it's a corporation or a state or a local government. Those are really the key points that I want you to understand from this week's topics. For corporations, remember that calculating the cost of capital involves looking at both debt and equity, and factoring in what percentage we should use in order to find our optimal capital structure, or to minimize the cost of borrowing. For city or state governments, it's important to remember these concepts in order to understand and remember and apply that interest rates impact the city government's ability to pay back funds. If interest rates are high and they have a high debt, issuing more debt could put a financial strain on the city. And we've actually seen examples of that in the recent past, where cities have had a hard time paying back debt. Some big cities have actually gone bankrupt because they've borrowed too much money. So understanding this optimal capital structure, understanding that not only interest rates, but the financial risk associated with borrowing money has an influence on city and state governments. Those are the key points that I want you to understand for this week's topic. For your homework, I want to do something a little bit different this week. What I'd like you to do is, I have posted 3 different articles in the Week 12 folder regarding state and local government debt. They're 3 very different articles. You don't have to read all of them, but what I want you to do is choose one of those that looks potentially interesting to you. And I want you to read any one of those articles about state and local government debt. These are recent articles within the last year, so it's about what's happening in the real world. And I want you to read that article and write a summary of what is the article teaching us, what's the article telling us. And then in your written analysis, I want you to give your own point of view and opinion about what you understand is happening, based on what you've read in the article, what you've learned about the cost of capital here, and what you see is happening in the world today. You can do some outside research if you want, and look at other sources. You're welcome to do that. I just ask that you please cite your sources. Let me know what sources you've looked at as well. And I'd like you to write, at least about a 2-page essay, at least 5 paragraphs, on analyzing or summarizing and analyzing, giving your opinion about one of these articles. Then upload your essay in the link, or through the link in the Week 12 folder by midnight Sunday of this week, Week 12. That's your homework assignment for this week's topic, the cost of capital. Just one last thing I want everyone to be thinking about right now. This is week 12, the beginning of week 12. That means we have basically 3 more weeks of teaching. Week 13, 14, 15, 3 more weeks of teaching, and then in week 16 you'll have your final exam. So there are actually 2 more chapters that we're going to be covering. In the Mayo book, it's chapters 22 and 26. Chapters 22 in week 13, and chapter 26 in week 14. Then in week 15, I'll plan on providing some review about the chapters that we've been talking about since the midterm examination. And in week 16, you'll have your final exam. It will be posted on Moodle. And I want you to know upfront now, plan your time accordingly, that the exam will be given. You'll be able to take the exam either Monday, May 10th, or Tuesday, May 11th. Your exam must be completed, must be done before the end of day on Tuesday, May 11th. The reason is instructors have to get all of their exams and homeworks graded and their final scores submitted to the registrar by May 13th, which is our graduation day. And so it's really important that you plan your time accordingly. 3 or 4 weeks left. I really urge you to catch up on your assignments and submit those. If you have any problems uploading any of your homework assignments to me, or you have any questions about the homework assignments, please don't hesitate to send me an email or give me a call. I'm in the office pretty much all day, every day, and happy to speak with you. Um, that's it for this week's topic. Look forward to hearing from you if you have any questions or concerns. Have a terrific week. Stay healthy and stay safe. Bye bye.